In the past 2 years, corporations have poured over $10 trillion into artificial intelligence development. Nvidia's stock soared from a modest $150 to well above $900, while tech giants like Microsoft invested $60 billion in AI infrastructure. Google, Amazon, Meta, all are betting heavily on AI. Nvidia's CEO, Jensen Huang, predicts AI will transform every industry. Meanwhile, Sam Altman claims artificial general intelligence is just a few years away, fueling a frenzy of investment. But beneath this hype, a stark reality emerges. The financial logic simply doesn't add up. Companies are spending hundreds of billions on AI, yet are generating almost no significant revenue in return. The use cases remain narrow, costs skyrocket, and profits are elusive. This pattern echoes the dot-com bubble of the late 90s, just on a vastly larger scale. A new technology appears, investors rush in, and valuations skyrocket. But then, the cracks appear. Promised real-world applications prove limited, expenses outstrip income, and companies face bankruptcy as stock prices collapse, wealth disappears, and the bubble bursts. We saw this with railroads in the 1800s, radio in the 20s, dot-coms in 2000, and crypto in 2021. Now, AI risks the same fate. The main issue is inflated expectations, excessive spending without commensurate revenue. Let's explore the numbers. In 2023, corporations allocated approximately $200 billion solely for AI infrastructure, covering data centers, chips, power, and cooling. That figure rose to $350 billion in 2024, and estimates for 2025 exceed $400 billion. In just 3 years, infrastructure expenses alone could reach nearly $1 trillion. This figure excludes research, hiring AI experts, acquiring startups, and developing applications, merely the physical hardware needed to support AI. Nvidia's role is central here. They don't spend this money directly, they earn it. Nvidia produces the GPUs, graphical processing units, that power AI. In 2022, Nvidia's data center revenue was $15 billion. By 2023, it grew to $47 billion, and in 2024, projections surpass $100 billion. Their earnings have multiplied sevenfold in 2 years, largely fueled by AI chip sales. Large tech firms are snapping up Nvidia's flagship H100 and H200 chips, each costing between $25,000 to $40,000. These are bought in tens of thousands, enough to build multi-billion-dollar AI clusters. A single cluster can cost $500 million to over $1 billion, and all major players, Microsoft, Google, Meta, Amazon, are constructing multiple such setups. Over recent years, tech giants have poured staggering sums into AI infrastructure. Microsoft has invested over $60 billion within just 2 years, funding data centers, chips, power systems, and acquiring stakes in OpenAI. Specifically, around $13 billion of that was directly invested in OpenAI, with the remainder fueling the machinery to support AI services. Google has committed approximately $50 billion to building its AI ecosystem, developing proprietary chips called TPUs, and purchasing Nvidia GPUs. Meta has allocated over $40 billion, while Amazon's investment exceeds $30 billion. These five, Microsoft, Google, Meta, Amazon, and Nvidia's clientele, including Oracle, Tesla, and smaller cloud providers, have collectively spent in excess of $300 billion in only 24 months, and their expenditures are gaining momentum. Yet, amid this monumental spending, a fundamental question looms. What tangible returns are these companies securing? Because pouring over $300 billion into AI infrastructure is only justifiable if it results in significant revenue and profit, yet the data suggests otherwise. Let's analyze individually. OpenAI, the pioneering force behind ChatGPT, reported an approximate annual revenue of $3.5 billion by late 2024, up from $1 billion in the previous year. Despite the impressive growth, OpenAI remains unprofitable, reportedly burning through over $5 billion annually solely on compute costs, which includes payments to Microsoft and other cloud providers. Consequently, the company's operating costs surpass its revenues by at least $2 billion annually, all while its valuation stands at a staggering $150 billion. a valuation that equates to a 43 times multiple of its revenue, despite persistent losses. Microsoft has woven AI deeply into its offerings, integrating it within Office products via Copilot, its Azure cloud services, and Bing with ChatGPT. However, the precise revenue generated from these AI-specific products remains opaque. Industry estimates suggest that AI contributes roughly $10 to $15 billion a year to Microsoft's income, significant yet modest compared to their $60 billion investment. It could take 4 to 6 years just to recover this infrastructure cost, assuming revenues hold steady and expenses don't escalate, a highly uncertain scenario. Google has concentrated its AI efforts on cloud services and embedding AI into search and advertising. These contributions are also not distinctly broken out, but estimates indicate AI generates approximately 15 to 20 billion annually, an amount that might cover, or slightly surpass, their 3 to 4 year break-even horizon, assuming costs aren't rising. Nonetheless, Google's Gemini AI is offered freely to most users as a defensive move to maintain market share against competitors like ChatGPT. This free distribution does not generate direct revenue. Rather, it aims to prevent losing ground. Meta's strategy involves integrating AI into ad targeting and content recommendations, improving their core services. Yet the revenue from their new AI products, such as the Meta AI Assistant, remains minimal. The company has devoted over $40 billion to AI development and Reality Labs, with most users accessing features free of charge. The core benefit here lies in enhanced ad efficiency, which boosts revenue indirectly. However, isolating the marginal revenue gains attributable solely to AI remains a challenge. Across these giants, the scale of investment in AI infrastructure is overwhelming. They have collectively spent over $300 billion in less than 2 years. But the critical issue persists. What is the return on this massive investment? The current revenue streams, likely in the range of $60 to $80 billion annually across all AI-integrated products, are only a fraction of the outlay. Standalone AI services like ChatGPT subscriptions and AI assistants contribute around $10 to $15 billion per year, equating to a spending-to-revenue ratio of roughly 20 to 1. In other words, generating enough revenue to recoup such vast investments could take 2 decades or more, an impractical horizon, especially considering the rapid evolution of technology and the likelihood of diminishing returns. This dissonance between expenditure and income underscores the fragility of the current AI economic model. As growth potentially stalls and revenues plateau, a real possibility given the limited use cases and the high costs involved, these investments may not pay off. Many of these giants are betting on a future where AI adoption scales exponentially. But the reality is that most practical use cases, like writing emails, generating images, or assisting in coding, are already saturated, and market consolidation is inevitable. Furthermore, AI's operational costs escalate as models become larger and more complex, demanding incredible energy resources. Training GPT-4, for instance, consumed enough electricity to power thousands of homes for a year, and large AI data centers now draw power comparable to small power plants. These energy bills are astronomical and environmentally unsustainable, with AI data centers projected to consume more electricity than entire countries by the late 2020s. Stock market valuations reflect this bubble's fragility. Nvidia's stock soared from around $150 in early 2023 to over $900 in late 2024, inflating its market cap beyond $3 trillion. Yet, this surge hinges on the assumption that AI spending continues exponentially. Any slowdown, and Nvidia's stock, priced at a high price-to-earnings ratio of about 65, face a sharp correction. Early signs of funding fatigue are emerging. Many startups are burning through their cash without viable revenue streams, and investors increasingly demand clarity on profitability timelines. The pattern of recent technological bubbles offers a cautionary tale. During the dot-com boom, numerous companies with no profits saw their valuations skyrocket before a painful crash. Many disappeared, and only a few, Amazon, Google, eBay, survived by establishing sustainable business models. Today, AI's hype resembles that era. High valuations, minimal proven revenue, and overwhelming costs. A typical example is Inflection AI, a startup that raised over $1 billion, created a capable chatbot, but failed to secure paying customers and was ultimately acquired cheaply by Microsoft, generating only a fraction of its original valuation. This recurring pattern, massive investments leading to minimal returns and eventual acquisitions at undervalued prices, is poised to continue unless the economic fundamentals change. The inevitability of a crash becomes clearer when considering three triggers. First, the failure of a major player, be it a large startup burning out or a big tech company writing off billions, would trigger panic. Second, stagnant or declining revenue growth would disillusion investors, as seen with the crypto market's collapse in 2022. Third, if operational costs become unsustainable, say, a large AI data center's power costs become prohibitive, companies will cut back sharply, precipitating a downward cycle. This would likely hit Nvidia hardest initially, with its stock predicted to plunge by at least 50 to 70% from its peak, causing trillions in market value to vanish. Larger corporations like Microsoft, Google, Meta, and Amazon would also suffer, but their diversified businesses might cushion some blow. Still, their AI divisions would face significant write-downs. For entrepreneurs and investors, the current scenario resembles a bursting bubble, with most startups likely to fail, around 9 out of 10, while a handful with strong revenue models and profitability pathways may survive or even thrive in the long run. As history illustrates, such episodes usually lead to industry consolidation and a more realistic valuation of the technological landscape, leaving the AI tools embedded into daily life, operating quietly like the internet, databases, and cloud computing, no longer the subject of hype, but essential infrastructure. In sum, despite the colossal investments and the undeniable advances in AI, the overarching economic picture suggests that much of this spending will not be justified. When the realities of limited use cases, soaring operational costs, and unrecouped investments come into focus, a correction seems inevitable. The only question remains: will you recognize the signs early, or will the crash catch you unprepared? If you enjoyed this analysis, please subscribe for more insights like this. Consumer-facing AI products remain primarily cost centers. For instance, Amazon's AI plays out in their Alexa voice assistant and fulfillment logistics, both side ventures. While AWS AI services may generate around $10 to $15 billion annually, Amazon's hefty investment of $30 billion over several years still hasn't yielded profits. Despite a decade of operation, Alexa continues to bleed billions each year, and adding more AI capabilities to a product that loses money only exacerbates the issue. Adding up the figures, the 5 major tech giants alone have poured over $300 billion into AI over the past 2 years. Their combined AI-related revenue, mostly from enhancements in core services like search, advertising, and cloud computing, brings in roughly $60 to $80 billion annually. The standalone AI offerings, such as chatbots, subscription services, and virtual assistants, contribute a modest $10 to $15 billion more. Consequently, this vast investment of $300 billion results in just $10 to $15 billion in new annual revenue, a staggering 20 to 1 spending-to-revenue ratio. To break even at this rate, they'd need 2 decades of such revenue, an eternity in technology terms where the landscape could shift 3 times over. The situation worsens when considering that these revenue projections rest on the assumption of continuous growth. But what if AI revenues plateau or decline around 2025 or 2026? Should that happen, the enormous spending will have been for naught. The core question revolves around the actual utility of these capabilities. AI can indeed generate text, produce images, analyze data, and write code, technically impressive feats. But the critical issue is whether businesses and consumers are prepared to pay enough to justify billions in investment. Currently, most consumer AI products are priced between $10 and $20 per month. ChatGPT Plus costs $20 a month, Microsoft's Copilot is around $30, and Google's premium AI service is roughly $20. At these rates, achieving significant revenue requires hundreds of millions of paying subscribers. As of late 2024, ChatGPT has approximately 10 million subscribers, yielding around $200 million per month, or roughly $2.4 billion annually from consumer subscriptions. OpenAI also services enterprise clients at higher prices, which push their total revenue to around $3.5 billion. Still, despite millions of users, the high compute costs mean they are losing billions each year. To turn profitable, they must either hike prices significantly, risking subscriber loss, or slash costs through breakthrough efficiency gains, neither of which is assured. Microsoft's Copilot has fewer than 5 million paying users at a $30 monthly fee, translating to approximately $1.8 billion per year. Meanwhile, Google's premium AI product likely has only about 2 million subscribers, generating about $500 million annually. These figures fall dramatically short of covering the enormous costs involved in running and developing these AI services. Moreover, the growth of subscribers has plateaued. The initial wave of early adopters has stabilized, with new signups roughly balancing cancellations, indicating a mature and possibly saturated market. This stagnation underscores an ominous reality. The relentless, trillion-dollar investments are not yet justified by scale or revenue, and turning that corner seems increasingly unlikely. If the growth in AI revenue stalls or reverses, the entire economic balance supporting the current valuations could unravel very quickly. This pattern reflects a product that has found its market, yet that market falls far short of initial expectations. Adoption within enterprises remains sluggish. While many companies are experimenting with AI, deploying it on a broad scale proves both costly and complex. It requires seamless integration with existing systems, extensive employee training, vigilant data privacy management, and substantial ongoing expenses. Most organizations discover that AI offers only modest productivity gains, about a 26% increase, according to an MIT study on coding assistants like GitHub Copilot, far from the revolutionary impact once envisioned. Such incremental improvements do not justify the enormous investments in infrastructure. This is where the bubble becomes most evident. Operating AI at scale is prohibitively expensive. Training a large language model, such as GPT-4, costs well over $100 million just for initial compute. Then there's inference, the cost of running the model to answer questions. Every prompt to ChatGPT incurs about 1 to 4 cents in compute expenses, depending on complexity. If the model handles 10 billion queries monthly, that adds up to between $100 million and $400 million each month, over $1 billion annually, merely for inference. Although software improvements and more efficient chips from Nvidia help, these costs remain colossal. As models grow larger and more sophisticated, expenses will escalate. GPT-5, whenever it arrives, will undoubtedly cost more to train and operate than GPT-4. Similarly, Google's latest Gemini Ultra is pricier than its predecessor, Gemini Pro, following the trend toward more expensive models rather than cheaper ones. To stay competitive, firms must develop larger, more costly AI models, fueling a vicious cycle of escalating expenditure. Without corresponding revenue growth, losses deepen. Currently, OpenAI finds itself trapped in this cycle. They need advanced models to justify their lofty valuation and compete with titans like Google. Yet, more powerful models demand higher investments, and their revenues are not increasing swiftly enough to offset mounting costs. Energy consumption compounds the problem. Training GPT-4 consumed roughly 50 gigawatt-hours, enough to power 5,000 American homes for a year per training session. Companies train dozens of such models, and inference itself demands vast power. A single Nvidia H100 chip consumes about 700 watts at full capacity. A cluster of 10,000 chips, typical of a mid-sized AI training facility, runs continuously at about 7 megawatts, a small power plant. Firms are constructing clusters with 50,000 to 100,000 chips, drawing anywhere from 35 to 70 megawatts around the clock. The resulting electricity costs are staggering. At commercial rates of 7 to 12 cents per kilowatt hour, powering such facilities costs $50 to $100 million annually, before factoring in cooling costs, which add another 30 to 50%. This relentless energy appetite underscores the sustainability crisis looming over AI's exponential growth. A single large AI data center can cost between $75 and $150 million annually just to power and cool its operations, and many companies are constructing dozens of these behemoths. By 2027, projections suggest that AI data centers could consume more electricity than entire nations like Argentina or Sweden, an unsustainable trajectory. Power grids cannot expand swiftly enough to meet this demand, and the environmental consequences are being overlooked amidst the hype surrounding AI's potential. Turning to the stock market, the signs of an unfolding bubble are unmistakable. Nvidia's stock surged from $150 in early 2023 to over $900 by late 2024, a six-fold rise in less than 2 years. Its market capitalization now exceeds $3 trillion, making it one of the most valuable firms worldwide. Yet, this valuation hinges on the assumption that AI investments will either sustain their current pace or accelerate further. Should AI spending slow or halt altogether, Nvidia's revenue would collapse, dragging its stock price down with it. Currently, Nvidia trades at a price-to-earnings ratio of around 65. That is, investors are willing to pay $65 for each dollar of annual profit. Historically, a PE above 25 is considered expensive. Over 50 indicates a bubble, and Nvidia's multiple is priced for perfection. Any hint of disappointment or a slowdown in chip sales could trigger a sharp decline. That slowdown is inevitable. Companies cannot sustain spending $300 to $400 billion annually on AI infrastructure indefinitely. Ultimately, they must demonstrate returns. When they fail to, investment halts. Already, signs of strain are evident. By late 2024, some AI startups began running out of cash after burning through funds raised in 2022 and 2023, covering costs for compute, talent, and expansion. Now, those companies are seeking additional funding, but investors are demanding clearer paths to profitability, actual revenue, and when they might break even. The flow of capital is slowing, but not completely stopping. This pattern echoes the dot-com bubble of the late 1990s, where internet stocks like Pets.com and Webin soared with no profits and sky-high valuations before imploding in early 2000. The Nasdaq index hit a peak of 5,000 in March of that year, then plummeted by 78% to 1,100 in October 2002, wiping out trillions in market value. The survivors, Amazon, Google, eBay, had concrete business models, solid revenue streams, and clear routes to profitability, whereas the failed firms relied solely on traffic, hype, and user growth without earning real money. Today, AI in 2024 bears striking resemblance to those overhyped internet stocks. The market is saturated with hype and lofty valuations, yet real revenue remains minimal. The technology itself is genuine. Just as the internet was transformative, AI holds immense potential. But the assumptions underpinning the current valuations, namely that all AI companies will find vast markets, are fundamentally flawed. Most won't. The actual market is smaller than the hype suggests, and the costs of deployment are higher than anticipated. To illustrate, take a closer look at the examples of the current players. In the story of Flexion AI, founded by a co-founder of DeepMind, most investors poured into its chatbot Pi, a capable, well-functioning tool, yet nobody was willing to pay for it, leaving it essentially free. By 2024, Microsoft stepped in, acquiring the team and paying around $650 million for access to the technology and to recruit Mustafa Suleyman. While some investors recouped part of their investments, the company's valuation still fell far short of the initial $1.3 billion. Over $500 million had already gone into building models, infrastructure, and compute costs, yet revenue remained minimal, and eventually, Microsoft absorbed parts of the operation. This pattern, companies raising vast sums, spending heavily on compute and talent, failing to generate meaningful revenue, and ultimately being acquired for far less or shutting down, will repeat across the industry. When the inevitable bubble burst occurs, the timing remains uncertain. History indicates it breaks when one of three key events unfolds. First, the failure of a major player, be it a large startup burning through billions or a big tech company writing off tens of billions in AI investments, can trigger widespread panic. Second, when revenue growth stalls and investors realize that the promised expansion isn't materializing, Like crypto in 2022, when the market acknowledged mainstream adoption was lagging, stock prices plummet. For AI, this signals itself when ChatGPT subscriber numbers plateau distinctly, when Microsoft flags underwhelming Copilot revenue, or when Google admits Gemini isn't delivering significant new income. These admissions will prompt a reassessment among investors. Third, costs will become unsustainable. As expenses climb, companies will be forced to cut back, and the ripple effects will hit the entire ecosystem. Nvidia's revenue could decline as clients cut chip purchases. Data center construction might halt. Layoffs will follow, creating a feedback loop of contraction. Reduced spending leads to lower revenues, causing stock prices to falter and market caps to dwindle, prompting further cuts, accelerating the downturn. While we are not there yet, signs point that we are closer than most realize. The initial phase of the crash will likely see Nvidia's stock the first to tumble, given its inflated valuation and heavy reliance on ongoing AI infrastructure spending. When AI expenditures wane, Nvidia could see a 50 to 70% decline from its peak, potentially plummeting from around $900 to below $300, erasing about $2 trillion in market capitalization. Meanwhile, tech giants like Microsoft, Google, Meta, and Amazon will also suffer, but to a lesser extent, perhaps 20 to 40%, since they have diversified revenue streams. Nonetheless, their AI divisions will endure heavy write-offs, billions in impaired assets, and underperforming data centers that don't meet revenue expectations. AI startups are poised for the harshest collision. Estimates suggest that as many as 90% will fail, with only those possessing genuine revenue and clear paths to profitability surviving through this tumult. The remaining startups will run out of funds, employees will be laid off, and billions of venture capital will be lost. This downturn mirrors the dot-com crash of 2002, where countless companies vanished and valuations collapsed, leaving industry survivors with a refined, more realistic foundation. Billions in venture capital are vanishing, a stark reality reminiscent of the 2002 dot-com bust when countless internet startups failed. Trillions in market value evaporated, and the industry streamlined into a handful of dominant players. Similarly, the future of AI will likely see only a few firms with robust models and tangible revenues endure and flourish. OpenAI, if it achieves true profitability, and perhaps Anthropic, if they scale effectively, might be among those survivors. Google and Microsoft, benefiting from diversification, are positioned to weather the upheaval. But most of the hundreds of startups creating chatbots, image generators, and AI tools will fade away. Now, I'll address the contrary view. Perhaps I'm mistaken. Maybe AI will uncover vast new revenue streams, prompting businesses to spend billions on AI services, and consumer demand will skyrocket, leading to multiple subscriptions per household. It's within the realm of possibility. However, I remain skeptical, and here's why. Use cases for AI are inherently limited. While AI can write emails, generate images, summarize documents, and code, once a single AI system handles these functions, why would the market support 5 or 6 different providers? Consolidation will naturally occur, leaving only a handful of winners and many failures. On the enterprise front, the opportunities are also constrained. Most companies don't need bespoke AI models. They require integration into existing systems. Revenue from services, unlike product sales, doesn't scale easily. Each integration demands custom work, which curtails profitability. Even widespread adoption of AI will struggle to justify the enormous infrastructure investments because the revenue growth simply can't keep pace. A common counterargument is that AI will become cheaper over time, following Moore's law, making operations more affordable and boosting profit margins. While this is plausible, the progress isn't swift enough. Nvidia's latest Blackwell chips are more efficient, yet they also cost more. The net reduction in cost per query is perhaps 20 to 30%, an improvement, but insufficient to offset bigger expenses. Models will continue to grow larger and more complex. GPT-5, for instance, will cost more to operate than GPT-4, even with advanced chips. The most ambitious promise hinges on artificial general intelligence, the idea that AI will reach a level of capability comparable to human reasoning, capable of performing any intellectual task. If realized, this would unlock unlimited revenue potential, replacing trillions of dollars in labor costs. But there are two substantial hurdles. First, despite the hype, true AGI remains at least 10 years away, possibly 50, and current AI remains narrow, excelling only at specific tasks. It cannot reason, plan long-term, or understand context the way humans do. Second, even if AGI arrives, its economic implications are uncertain. If AI becomes capable of performing all knowledge work, then who will pay for it? Replacing workers without replacing their income would shrink consumers' purchasing power, contraction set in motion. This creates what's known as the automation paradox. Technology that displaces jobs can inadvertently undermine the markets it hopes to serve, casting doubt on its capacity to generate sustained, vast revenue streams. This phenomenon epitomizes the automation paradox. Technology that eradicates jobs can ultimately undermine the very markets that fuel its growth. Accordingly, artificial general intelligence might not deliver the abundant revenue that investors anticipate. Instead, it could trigger an economic upheaval demanding a profound societal overhaul, something that doesn't generate trillions in subscription revenues for tech giants. If you're invested in AI stocks, whether directly through giants like Nvidia or indirectly via tech-heavy index funds, some critical insights are in order. My analysis, not financial advice, suggests AI equities are dangerously overvalued and poised for a sharp correction. For example, holding Nvidia above $700 places you at significant risk. Consider locking in profits if your entry was around $200 or $300. Those gains could vanish swiftly when the downturn hits. Big tech stocks like Microsoft, Google, and Amazon are somewhat safer, but not immune. Their valuations will likely shrink, possibly by 20 to 40%. If you're comfortable with that possibility, retain your positions. If not, it's wise to cut back. For investors in AI startups via venture capital or SPVs, beware. The risk of failure is extreme. Roughly 90% of these ventures will fail. Some may deliver outsized returns, but most will become worthless. It's prudent to invest only what you can afford to lose entirely, diversify your holdings, and avoid trying to pick the precise peak. The bubble is unmistakable. The only uncertainty is when it will burst. Since timing market tops is impossible, the best approach is to de-risk gradually. Take profits, rebalance into more stable assets, and be patient. When the crash occurs, opportunities will emerge to acquire high-quality companies at reasonable valuations. But these opportunities will appear only after the decline, not before. Looking ahead, I predict that by 2025, AI spending will decelerate. It might grow at 20% annually instead of 50%, disappointing investors. By mid-2026, major corporations will begin reporting that AI revenue falls short of expectations, leading to write-downs. Nvidia's stock could decline by 40 to 50% from its peak. By 2027, the bubble will have burst definitively. AI startups will be failing en masse. Valuations have plummeted, and industry consolidation will be underway. This marks the industry's trough. Come 2028 or 2029, AI will stabilize. Viable companies will demonstrate steady revenue growth, profitability, and sustainable integration into the economy. However, the total market value will have shrunk dramatically, perhaps from a high of $10 trillion down to just $2 trillion, erasing $8 trillion in market value. This pattern mirrors past technology bubbles, where the initial hype far exceeded the realistic market capacity. The crash clears out the excess, leaving behind resilient firms with genuine worth. Over the long term, AI will become a quiet backbone, ubiquitous but unremarkable, analogous to the internet or cloud computing, integrated into daily life and industry. The valuation bar will shift from hype-driven exuberance to utility-based assessment. After the storm, the technology's true value will be recognized as foundational, not fantastical. AI will settle into the background, no longer hyped but foundational. Much like the internet, databases and cloud computing have become essential yet unremarkable. Valuations now mirror practical utility rather than hype. Over 3 years, $10 trillion have poured into artificial intelligence. Yet the industry's annual revenue likely hovers between $60 to $80 billion. The fundamental math simply doesn't add up. Costs are exorbitant, earnings are modest, and the promised use cases remain more limited than projected. Stock prices are inflated, reflecting an idealized perfection that the reality cannot sustain. This isn't a case of fake technology. It's a bubble driven by impossible expectations. When the actual performance catches up with the true potential, reality will inevitably prevail. The crash is imminent. The only question is whether you'll recognize it before it arrives or only after.